Hello, I'm Los Angeles City Controller Ron Galperin, and I'm so pleased to be part of the Los Angeles Public Library's continued work to promote financial literacy. All year long, the library, through its outstanding Department of Lifelong Learning, hosts life-changing programs that teach and support financial empowerment, immigrant integration and inclusion, and health and wellness. And the best part about it is that it's all free. As controller of our city, I make sure that public dollars are being put to good use, keeping our government honest, responsive, and accountable. Because people want to know and deserve to know that their government is doing its best to serve them. While it's important for the city to plan how we use our money wisely, I want you all to know that it's just as important for you to do the same. Because the city's financial health depends on the financial health of all Angelenos. The programs that the library is hosting this week and throughout the year are here to help everyone succeed and to make positive financial choices for our futures. I'm so grateful to all of our libraries and incredible staff, and VITA and its volunteers for all they do to ensure that you and your families have the tools and resources not only to prepare your taxes, but to help you be on the right financial track. Thank you.
Hi, everyone. Good afternoon. I'm Caroline Zakari, and I work for the Office of Civics and Community Services here at the Los Angeles Public Library. Welcome to Financial Literacy Week. Today's presentation is called Investing Basics, and it's part of a week of programs in support of financial literacy. And this program is brought to you by the Securities and Exchange Commission and LAPL. Today, Carol Lally from the SEC will be talking about investing strategies, including information about common scams, investment fraud, and cryptocurrencies. Please keep your questions coming throughout the program, and we will have a brief Q&A session at the end of the presentation. Carol, here you go.
Good morning, or I guess good afternoon, now at noon. Thank you, Caroline, and thank you to the LA Public Library for inviting me and the Securities and Exchange Commission to speak today. I'm really looking forward to it. I do have a PowerPoint presentation. I'm going to take myself off camera so that you can see the PowerPoint presentation and not be distracted by me. And then at the end, I'll come back on camera to take your questions. So if you give me just a minute, I'll get the PowerPoint queued up. Just 1 second, I apologize. It's here, but there we go. There we go. Sorry about that. So hopefully you can all see from the start of the PowerPoint, investing basics, which is what we're going to talk about here today. I have to start every presentation with a little bit of a disclaimer, so let me just say that everything that I say today are my own views and not attributable to the SEC. I cannot give legal or business advice. And what we're going to talk about today are just some investing basics. And as you can see on the slide, an overview of the SEC, some strategies for smart investing, red flags of fraud, which unfortunately is quite common in this area, and some common scams that you might be exposed to and how you can take steps to avoid fraud and protect yourself. Before we get started, let me tell you a little bit about my own background. I'm an attorney. I've worked at the SEC now for almost 19 years. And I worked for roughly the first 12 years of my career in the Division of Enforcement, prosecuting and investigating securities fraud. So the kind of scams that we're going to talk about today, I've actually investigated and then prosecuted in court, and really am quite familiar with what steps fraudsters will take to try to separate you from your money. So I look forward to sharing some of my experience with you. For the last several years, I have supervised the group in the Los Angeles office of the SEC that conducts investor outreach, like I'm doing here today. And then it also takes in the tips and complaints that we get from the public that lead to new investigations and hopefully allow us to identify problems that are going on in the market and put a stop to them as quickly as possible. The Los Angeles office of the SEC oversees a pretty wide region, both geographically and in terms of population. We oversee all of Southern California, Hawaii and the Pacific Islands, Arizona, and Nevada. So that's the region of the SEC's Los Angeles regional office that I'm a part of. So let's jump in and I'll give you a little bit of background about the SEC. If you don't know much about the SEC, here's the disclaimer that I gave right at the beginning. The SEC is the exclusive federal regulator of the securities market, and it has a three-part mission, which is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. We are a small to medium-sized agency, but the market that we regulate and the entities and individuals that we regulate really quite large, as you can see on this slide. Thousands of investment advisors and mutual funds and reporting companies and broker dealers, and then self-regulatory organizations like FINRA, which used to be called NASDAQ, and the PCAOB. And so really quite an expansive industry that we regulate. Almost everything that we talk about today is going to come, really everything that we talk about today, except for some personal experiences, if I get a chance to share them with you, will come from our website, www.investor.gov. So after the presentation is over, I encourage you to go to the website, look around. It's really very well organized and user-friendly, and it has a lot of helpful information in addition to the information that I'm going to present here today. So now that we've got the kind of beginning part out of the way, let's jump into some strategies for smart investing. And right off the bat, let's talk about the difference between saving and investing. Saving is what you do for things like emergencies and education, sort of defined more short-term goals where there's a certain amount of money that you want to make sure you have set aside for these goals and emergencies. If you don't already have an emergency fund, this is an important basic step that you should undertake before any kind of larger investing strategy. And that emergency fund is really money that is set aside for some kind of unexpected events, much like we have seen in the last year with the pandemic. It's important to have this emergency fund to provide a buffer in case unanticipated events take place, and you need to have these savings in order to provide for yourself and your family. But investing is different. Saving is the money you earn, but you don't spend because you've set it aside for these emergencies or specific life goals. Investing is taking that money and making it grow, not just setting aside, but making it grow. And once you've got that emergency fund established, debts are paid down or paid off and within a manageable level, then you really want to focus on the next step, which is investing, making your money grow. You can't just save or stick your money under the mattress because unfortunately, as any adult who's already been on some part of their journey putting money aside to try to save for something knows, inflation is real and things that cost a certain amount of money 5 years ago cost more money now. Just as you can see in the example and slide in front of you, if you wanted to buy a 1995 Ford Mustang back in 1995, $22,000, almost $23,000. But over the course of the last 25 years, the price of that car has gone up more than 100%. So if you stuck $23,000 under your mattress back in 1995, hoping to buy that same car today, you would be out of luck. You need to get a loan or find some other source of money in order to pay for it because the car is now $45,000. That's why you can't just stick your money under the mattress. You have to also have a strategy to make your money grow. That's what investing is. And investing builds on the power of compound interest. You can see on this slide an example of a one-time investment of $1,000 that's made in the graph on the slide in year 0 and then is placed in some kind of investment where the money grows for over 40 years. That's the red line on the graph. And you can see that original $1,000 investment builds to $15,000 over those 40 years with the power of compound interest. Because if you're earning interest on your investment, say 5%, 7% interest on your investment, then that interest is paid to you and you earn interest on the interest. That's compound interest, and that's how money grows. And that's why having an investment strategy is important, because you make your money grow for you. No matter what kind of investment you make, whether it's something like an annuity or stocks, that investment has risk. And that's a very important thing to keep in mind. No matter what you're planning to put your money in, it's got some level of risk, and it's important to identify it and make sure it's consistent with your own risk tolerance. Generally speaking, lower risk investments are things that are like cash itself or CDs, but they have the potential for much lower return. So these are appropriate for short-term goals. And then as you move through the investment classes, the most common investment classes, bonds tend to have potential for higher return, with the key word with all of these investments being potential, but also greater risk, with then the riskiest typical category being stocks. The highest potential for risk, by that meaning loss or the business going under, but then the highest potential for returns as well, and that might be more appropriate for long-term goals depending on what your own risk tolerance is. Here's another way of breaking down these kinds of investments. As I say, cash roughly means things like savings accounts, but also CDs and money markets. And again, have the lowest potential return, moving through bonds and then stocks, which historically have offered the greatest growth. You can manage risk by allocating your assets and by using diversification. In other words, not putting all your eggs in one basket. If you've got these investment funds, probably don't want to put them all in one type of investment. You probably want to diversify. And one of the easiest ways for what the SEC sometimes calls retail investors or mom and pop investors or Main Street investors, which just means you and me, ordinary people, one of the easiest ways for us to diversify is to invest in a mutual fund or an exchange traded fund. Now, this isn't necessarily the investment that's right for everybody, but one of the reasons why it's right for a lot of individuals is that it's a pool of money that's managed by a professional, but is invested across a number of different asset classes and a number of different industries. So you get this diversification by investing in the mutual fund instead of having to go out and identify for yourself 50 or 100 different stocks or bonds that you might want to invest in. You can invest in a mutual fund that does that for you. They're usually fairly affordable, and they're usually fairly liquid, meaning you can sell them relatively easily, which makes them really attractive for a lot of individual investors. They will have the risks of the underlying securities. So whatever stocks or bonds that are in there, the risks of those particular stocks or bonds in the mutual fund are the risks of the mutual fund overall. Now on the screen, you can see a slide that is how that tries to represent how a mutual fund might diversify. So this slide represents the holdings of a mutual fund that is tracking the S&P 500. So each square represents a holding in that fund that corresponds to a particular stock. So here you see in the top left-hand corner, Google is a stock that's held here in the technology section of this mutual fund. Whereas down below, you can see in the financial section, JPM, that's JP Morgan. Now, the squares that are represented in green are stocks that are having an up day. So Google is, not surprisingly, having an up day of over 2% this particular day. And then the squares that are represented in red are having a down day. So Microsoft, for example, lost a little bit of money on this particular day. But the red squares are hopefully balanced out by the green squares in the mutual fund. And that's how diversification helps you. Because while some of the stocks are posting losses, others are posting gains. And that way your risk is managed. And again, you don't have all your eggs in one basket. There are two types of funds, generally speaking, actively managed funds and index funds. An actively managed fund is exactly what it sounds like. It's being actively managed, often in an attempt to outperform a market index, which sounds great. Like, who wouldn't want a fund that does better than an index like the S&P 500? Whereas an index fund is really attempting to track the performance of that index. It's not going to be as actively managed. But the downside of the actively managed funds is the fees tend to be quite a bit higher. And so not only do they have to outperform that market index to give you the higher return, they've got to outperform it enough to cover those additional fees, which often can be quite hard to do, not to mention that outperforming a market index is also hard to do as well. So for a lot of individual investors, an index fund makes more sense because the fees are important. All investments have fees and they matter. Here on the screen, you can see the impact of fees on the ultimate returns that an investor would get. We've got three investors who have each invested $100,000 in the same investment for 20 years, but they've invested it in different mutual funds. So it's the same underlying investment, but one of them has invested in a mutual fund that charges a 1% annual fee, here represented by the green line, another a 0.5% annual fee represented by the red line, and then the third, a 0.25% annual fee represented by the blue line. Now, that doesn't sound like a very big difference in the fees, but as you can see over time, it really adds up. So over those 20 years, the person paying the highest fee is ultimately going to end up with roughly $180,000 in their return that they get from their investment. All of these investments are generating the same return. Whereas the person with the blue line with the lowest fee of a 0.25% ends up with almost $210,000. So, tens of thousands of dollars difference in the ultimate return that they get at the end of 20 years, even though all their investments are earning the same return because they are paying a different fee. So even small differences in these fees that you pay for mutual funds or an investment advisor can make a really big difference on the ultimate return that you see. So it's important to know what the fees are for the investment that you placed your money in. One way you can figure that out, because then that's the next question that I always get is, well, how do I know? You can get these long documents that may be complicated and hard to understand. This is a really useful tool. If you go to the FINRA's website, here down at the bottom, you can see finra.org and look for the fund analyzer. You can put in quite a large number of funds and then compare them to each other. There are, I think, something around 40,000 funds in the FINRA fund analyzer. So if you've got 5 or 6 that you're considering, put those fund names in, do the search, and then it will analyze them for you, and you'll be able to compare certain characteristics of each fund, including the fees. Here are some questions you might ask if you are picking a mutual fund or an index fund for yourself. Bottom line, you want to make sure that the fund matches what your goals are and what your risk tolerance is. And you want to make sure you understand what the fees and expenses are. You want to have this explained to you by the person who is offering to sell you the fund. And these are some good questions that you can ask. And I would also encourage you to go to investor.gov and look at the materials on mutual funds and questions that you might ask related to mutual funds. So now that we've got a kind of general sense of what the investing landscape might look like for you, let's talk about what red flags of fraud you need to be aware of, because as I say, unfortunately, fraud is quite prevalent. FINRA did a survey several years ago, and of the people that it surveyed, more than 80% had actually been solicited for a potentially fraudulent offer. Even more troubling, close to 20% had actually responded to the potentially fraudulent offer, and right around 10% had actually lost significant money to the fraud. So it's unfortunately quite prevalent. As you can see, roughly $50 billion a year is lost to fraud. I can't tell you the number of calls and emails that my office gets every day related to potential scams. It's something that is definitely a problem. It's something that you need to be aware of and arm yourself to protect yourself against potential fraud. Some red flags of fraud, I think, when I tell them to people, they seem like common sense, and in many ways they are common sense. But I would just advise you that fraudsters tend to be very good salespeople, very smooth, very good at persuading people, the kind of person that you would want to hang out with, sit down and have a beer with. You would, share little league coaching duties with these kind of people, be happy for your children to go over and play with their children. They just give off a very persuasive, trustworthy, good guy vibe, but behind that might be the fraud. And so even if you're approached by someone who really, maybe you have some relationship with, or they know someone that just seems like a good person, you want to make sure you're still asking yourself these fundamental questions. Are they promising to me something that sounds too good to be true? As I showed you before, the potential of high return corresponds to high risk. So if somebody is offering you something, this is guaranteed, or this has a potential for a really high return of 15, 20% or more, and it's not risky at all, that's a huge red flag, because that's not how investments work. Returns and risk are correlated. So an investment that offers a higher return is telling you right there that is a risky investment. That's why you're getting the potential, and the key word again is potential, higher return, because there's a greater risk of loss. If there's a pressure to buy right now, if there's a lack of documentation, that's very concerning. A security, when people think of a security, they typically think of something like a stock or a bond, which are securities. But generally speaking, the legal definition of a security is a pooling of money by individuals or entities who then give over control to some other third party who's going to generate the profits. So that might also take the form of something like an investment contract, or what people sometimes call a private placement memorandum, or something along those lines, which might be just a really rather simple document, or sometimes even no documentation at all. In those circumstances, that's a big red flag. Again, not that there aren't legitimate investment contracts, but usually for these kinds of investments with securities, there is fairly detailed documentation, and almost always they should be registered with the SEC. And you can go on our website, and I will show you how to do that, to look up registrations for securities. And if there is no documentation, if you can't find the SEC registration for that securities offering, or at the very least, a filing called a Form D, which you can find on our website, which is what people file when they claim they are exempt from registration with us. That should be available. If they're claiming they don't need to be registered with the SEC, you should be able to find that exemption filing on our website. That kind of lack of documentation is a very big red flag, as is a salesperson who is unlicensed or unregistered. So knowing that this lack of documentation or registration, and the lack of licensing and registration of the salesperson are important, I'm going to show you how you can find that information on our website. Unsolicited offers, you should always be quite suspicious of unsolicited offers, no matter what form they come in, by the phone or email. Generally speaking, the best advice is to ignore them and do your own research. The best investment is the one that you find, not the one that approaches you. Something that we're getting a lot of questions about now is timing the market and trying to pick winners. This has come up a lot, especially in light of all the press that GameStop has received. Generally speaking, actively trying to time the market results in underperforming, getting a lower return than you might in something like an index fund that tracks the market more generally. It's very, very hard to time the market. Even people who are professionals, who make their living as broker-dealers or investment advisors, or managing money in some way, that's their career, they've gone to school, they've got an MBA, they have a very hard time timing the market themselves. And generally speaking, studies have shown that it's just not an effective investment strategy. So I would strongly encourage you to think very carefully before embarking in this kind of investment strategy. Usually slow and steady wins the race in terms of investment planning for the long-term future. Short-term trading in a volatile market can lead to significant losses, and there are some kinds of trades beyond just buying or selling a security, like margin trading or options or short sales, that can magnify the risk. So you can lose much more than you invested. Generally speaking, if you buy a stock for $5 and the company goes belly up and your stock value goes down to zero, well, you've lost $5. But if you trade on margin or options or short sales, the losses can be many, many times larger than just that $5 investment. And so it's really extremely, extremely risky, and something that you should be quite cautious about participating in, even if you are a fairly sophisticated investor. Know what your long-term objectives are, and don't let your short-term emotions disrupt your long-term financial goals, because making and sticking with a financial plan is really, as I say, what wins the race for most people. Slow and steady winning the race. And I would advise you to be extremely careful about investing based on what you see on social media. We do see more and more that a lot of investment scams are perpetrated through these medium, whether it's a social media platform or something like YouTube. This is how people communicate with each other now, and so this is how fraudsters communicate as well. What kind of scams do we see in the securities investing space? Well, let me give you some examples of some very common scams that we see over and over again. Pump and dumps are extremely common. If any of you saw the movie The Wolf of Wall Street, that portrays a real person, George Belfort, who was involved in a number of pump and dumps that typically involve penny stock or microcap companies, where the stock can be bought, as the name suggests, for less than $1 or close to $1, really very inexpensive. And so lots of first-time investors think, hey, this is a great place for me to sort of dip my toe in the water and figure out investing. There are, of course, plenty of legitimate startup companies that are in the microcap space, but it's also a place where there are a lot of fraudsters, because it's also cheap for the fraudsters to get involved in this space. And because the companies are relatively small, they can get a hold of a lot of the shares of the company without the rest of the investors knowing, and then manipulate the market, typically by having somebody hype the stock through press releases or a Twitter campaign or something like that. And then as the price of the stock goes up, because you and I are buying it because we think it sounds really exciting, the insiders who already have a lot of shares that maybe they got for even less than 10 cents or 30 cents or $1, whatever the stock is trading for, maybe they got their stock for 0 cents for free, basically, as they started this fraudulent company. They're able then to sell that stock, dump it into the market. So even if you're buying it at 30, 50 cents, and it seems relatively cheap, if the fraudster got it for $0, nothing at all, that 50 cents per share can add up, because typically they tend to have millions of shares. What happens then is eventually people figure out that the hype is false. They're not building or doing the thing that the business said they would do, and the price of the shares falls dramatically, and you're left holding the bag with the worthless shares. This is a really common scheme in this area. I actually investigated and prosecuted a pump and dump where the company was claiming that they had these airport kiosks. You'd go in the airport, you'd go to the electronic kiosk, and you'd be able to punch on the electronic kiosk and find the shortest path to your gate, or the restaurants that were closest to your gate. And they claimed to be rolling out dozens of these across airports all across the country. In fact, there were no electronic kiosks. It was a complete lie. It was being touted by some touters. And while the price of the stock went up dramatically, along with some other false press release they issued, the insider was selling millions and millions of shares. That's a typical pump and dump, and unfortunately something we see quite often. In that particular case, we did prosecute, and just in case you're not aware, the SEC is a civil agency, not a criminal agency, We do have pretty expansive civil remedies, but we cannot send people to jail. We don't have that authority. We do frequently work with the FBI or other criminal authorities who may bring a parallel criminal case. But in that particular case, we shut down the company. We barred the individual from working in the industry, and we got disgorgement, which means some money back from the fraud. So those are the kind of remedies that the SEC can seek. Ponzi schemes, another kind of scam that unfortunately is extremely common, and you've probably heard quite a bit about. I would say a good third of the tips that I get involve potential Ponzi schemes. This is where frequently we see the unregistered offering and no documentation, where they're promising high returns with little risk. So this is something you should be very aware of. Pyramid schemes, which are sort of similar, but basically there's an emphasis on recruiting and getting other people to join in a downline where people get compensated for some sort of complex commission or compensation structure. This is a scheme you should also be very aware of, and again, is very common, and you should proceed with caution if you're approached to participate in this kind of multi-level marketing venture, because very often there is no demonstrated revenue from the retail sales of whatever the product or service is that's supposed to underlie that multi-level marketing compensation structure. Then I think it's helpful to talk about cryptocurrency, which obviously gets a lot of press now. Sometimes a cryptocurrency can be a security if it's not being used just as a token, but if it is a digital asset that functions the way that I described earlier in the presentation, where people are putting their money in together into some kind of pool, and then they are passive. And the entity and the individuals who control the entity will be generating profits for everybody else through their efforts. And you are expecting as a passive investor that those profits will be generated for you on your behalf. The thing that is generating the profits could be any kind of thing. It could be a real estate venture, but it could also be something like a digital asset where the mining is supposed to generate profits for the individual investors. As you can see on the slide, the SEC has charged people in this space. In particular, back in not that long ago, the SEC charged 3 individuals claiming to operate a digital trading platform, and they raised $11 million from individuals claiming that they were a Bitcoin exchange and that the tokens would be deliverable. And the invested funds would be used to develop a coin that would be mineable and tradable. And we alleged that offering was a sham. So this is something that the space that the SEC is active in. Again, whenever something is new, that's going to attract a lot of innovation, a lot of interest and investment, but it also has the potential to attract a lot of fraudsters because people don't quite know how the landscape is going to shape out yet. So if you are interested in investing in an ICO or cryptocurrency, again, I would just proceed with caution. And there are some resources on the SEC website that I'll show you that can help advise your investing. Fraud, unfortunately, very often comes from within the community that is being targeted. Unfortunately, fraudsters know that that is a good way to build up trust almost right away if they target the members of the group that they are part of. So even if you're working with someone that you know, if that person wants to provide you investment services for a fee, whether it's a commission or a percentage of assets under management, no matter how well you think you know that person, you need to check their background. And remember that the person telling you about the investment may themselves have been scammed. Unfortunately, there is no group that is not targeted by fraudsters within the group itself. One of the last cases that I investigated and prosecuted involved somebody whose family was in the military and was very active in their faith community. And those are exactly the people that he targeted: other military personnel, military retirees, and that people who were part of his faith. That's quite a common pattern that we see in Ponzi schemes. So again, no matter who you're dealing with, you want to check up on them. So what are these steps to avoid fraud? Investor.gov, the website that I mentioned at the beginning, is where you want to go for background research on checking the individuals that you're might be working with who are trying to provide you investment advice or services, but also where you want to go to get more general information. So I'm going to stop sharing my PowerPoint for a moment, and then I'm going to go into the website investor.gov because I think it's actually even more helpful than seeing the slides. So give me just a minute to pull that off. Let's see if we can get. There we go. So hopefully you can see the screen investor.gov, www.investor.gov. This is the landing page. And right up at the top, you can see, check out your investment professional. So I mentioned the Wolf of Wall Street, and that it was based on an individual, real individual, Jordan Belfort. So let's say Mr. Belfort was to approach you and offer to give you investment advice. You could go to our website and put in his name and check him out. And right there, we can see he is a previously registered broker, but he's got a disclosure. So let's click on the full report and see what else we can see. Here's some information that I would want to know right away before I did business with Jordan Belfort. You can see right at the top in red, barred. This individual has been barred from acting as a broker dealer or investment advisor. Wouldn't you like to know that before you gave Mr. Belfort your money? So let's click on detailed report and see what else we can see. These reports, I think, are really pretty readable and accessible. You've got the beginning part of the report that just kind of gives background information about the report that's called a broker check report. But then as you scroll through, you can see what exams this individual has taken. You can see where they were employed. There's a little bit more about the exams and their employment. And then at the end, there will be disclosures if they've had a regulatory action taken against them, meaning they've been sued by one of the state securities regulators or the SEC or FINRA, customer complaints that rise to the level of something that might be resolved in an administrative forum or result in money going back to the customer. That information is all going to be here. So for Mr. Belfort, as we can see towards the bottom of his report, SEC sued him and he was ordered to pay over $1.5 million in disgorgement and prejudgment interest. So that's the kind of information that is in these broker check reports. Hopefully the individual that you might be doing business with isn't going to have the same kind of background that Mr. Belfort does, but it's really very helpful. Then you can find out a fair bit of information about them. So that's one of the things you can do on investor.gov. But then just so you can see a little bit more about the website, there's all kind of information on here. Introduction to investing. So if you're just getting started, there's some basic questions to ask. Financial tools and calculators. All kinds of interesting calculators that can help you determine Social Security retirement estimates or how compound interest can work for you if you've got a particular investment with a particular interest rate that you're planning on participating in. Then you can see how your money will grow over time at that investment with that interest rate. Some more information about scams, all kinds of information about doing research and understanding fees, and then some particular information. So if you're interested in ICOs, here's the spot under additional resources that clicks directly on ICOs and gives you a fair bit of information about tokens, offerings, and digital assets, some of the frauds that we've seen in this area. So really a lot of information here. I'm going to go on one other website of the SEC's. This is our more kind of government-facing website, sec.gov. And we can look up particular investments here as well. So if you want to look at not just the individual who's selling you the investment, but the investment itself. So for example, I'm just going to put in, I'll put in Starbucks, which I think, I was at Starbucks just this morning. Maybe I want to buy Starbucks stock. So I put in the name of the company and up pops a whole lot of information. You can see basic information about the company, what kind of business it is, the state that it's incorporated in, its business address, information about when its fiscal year ends, as well as information like 8Ks, which if you're not familiar with, relate to things like press releases or directors leaving, 10Ks and 10Qs, which are their quarterly and annual reports, which include financial reports and have quite a bit of information in there about the financial health of the company, which you would probably want to know before you invested in the company. But if you're saying to yourself, well, these documents sound complicated and I'm not sure I would understand them even if I access them, right here on sec.gov, we have a guide on how to research public companies. That's really very helpful and explains what these documents are and what kind of information is likely to be in them. Here you see the 10K, the annual report, is explained. So really a lot of useful information here on this website and where you should go. And as I said, if you're researching an investment and you put in the name of the investment and nothing pops up, that is in and of itself a very big red flag. So I'm going to stop sharing this screen and go back to my PowerPoint, which we're almost at the end of, so that we can ask them, I can answer any questions that you might have. All right, so back to the PowerPoint, which shows you walk through investor.gov and you're able to check the individual, and then you're going to go to Edgar. That's what I showed you on sec.gov, and you'll be able to check whether or not the product itself was registered. As I said, scams often involve these unregistered companies, so that is a red flag if you don't find something there. Here's a slide showing the Edgar website, and again, the guides on how to research public companies that will help explain some of the information that you'll find in this database. Other things you can do to protect yourself: be very careful about anybody who claims to be from the government. Usually we don't call investors. We certainly don't call people providing investment advice or those sorts of things. That's not what the SEC does. So if somebody calls you claiming to be from the SEC or any other government agency, I would then get their information, hang up the phone, and call the office of the agency that the person claims to be from. Don't pay for investments with credit cards. Please don't send wires overseas, especially to unknown salespeople who you haven't met. Don't share personal information, and don't pay an upfront fee in order to claim stocks or winnings. That's not how legitimate lotteries work. That is a particular kind of scam that's called an advance fee fraud, where individuals ask people to send a small amount of money and then they claim they will release a larger amount of money. Well, you send that small amount of money, $50, $100, and you never hear from that person again. And as you can imagine, if they pulled that same scam with thousands of people, the $50, $100 starts to add up quite nicely for them. So don't pay an upfront fee in order to claim any kind of proceeds. That's not a legitimate investment or lottery. That's a scam. Generally speaking, how do you protect yourself against fraud? Be aware of these common red flags, be aware of these common investment schemes, and research both the financial professional and the investment product before you give your money to anyone. SEC resources, really your strongest resource is to go to this website, investor.gov. There's just a wealth of information there. And then you can always reach out to us. I have on the screen the 800 number and the email address in red. That goes to our main headquarters in DC, which has quite a large staff there. But you can also reach out to us in Los Angeles at losangeles@sec.gov. We are on Twitter at @LosAngeles_SEC, and of course we're also on Facebook. So hopefully this contact information is helpful and this presentation has been helpful to you. I'm going to stop sharing my screen and put myself back on camera so that I can take any questions that you have. And thank you. I know I talked kind of fast, but hopefully this has been helpful information for you.
Oh, there you go. Thank you, Carol. This is great information. I learned a lot. Let's get to the questions. Liz is asking, will this presentation be available after the live stream? Yes, it will be available on our Facebook and YouTube pages, on the main LAPL pages. YouTube is probably a little bit better because it is going to be on there for longer. Definitely it's going to be for a few weeks, if not longer than that. So you can look at the presentation, later on, take your time. I know we went through everything quickly now, but yeah, you can browse it definitely later. I think we have another question. Oh yeah. So KB is asking. He's tempted to, or she is tempted to invest, having the questions on the screen, having never done so. 67 years old. So I guess that would be like, how would they get started investing if
Yeah.
they've never done so? Even
Yeah.
older or later.
Yeah, I don't think it's ever too late. Whatever your age is, you want to be careful and follow. I would, strongly advise you to take into account some of the considerations that I talked about today. Um, Having a shorter time horizon means for most people, your risk tolerance is probably lower. If you invest at a young age and you lose money, then you have the rest of your hopefully life and career to recover those losses. If the market goes down, and it's down for 5 or 6 years, that's probably okay because then it's going to be up. Start in your 20s and it goes down. Hopefully in your 30s it goes up. Those of us who are closer to the end of our retirement age, we don't have time to recover those losses. We saw people in the recession who are very close to their retirement age and the market goes down. They don't have the rest of their professional life and their 401k or whatever to recover the losses in the market. So I do think you probably, for most people, need to be aware of their risk tolerance and be aware that there's less of a time horizon to recover from risky investments. So for a lot of people, I cannot give you business or investing advice, but for a lot of people at that point, less risky investments are what's appropriate for them. But that doesn't mean it's too late, that doesn't mean it's too late. And there are specific references for senior investors on investor.gov. If you go under that additional resources tab, you'll see some information for seniors. We'll talk about some of the scams that specifically target seniors, but it will also provide resources on investing. So it's not too late, just be aware of what your own risk tolerance and investing horizon is.
So on that note, if someone is just starting out investing, I mean, where would they start? I mean, would they go to the investor.org and
Yeah, I would suggest they do go to investor.gov, and right there, one of the very
.gov,
first
sorry.
tabs is, that's okay. Lots of things are .gov or .com. This one's or .org. This one's .gov. Investor.gov. On the left-hand side, the very first tab is Introduction to Investing, and I would start there and really read up so you get a good sense of what the market is like. And again, I cannot give investing advice. You may be somebody who has a higher risk tolerance or wants to dabble in trading individual stocks. But for a lot of individuals, mutual funds are a very wise decision because of the low cost and the professional management and the diversification. So I would encourage you, as you're learning about investing, to read up on mutual funds. We have quite a bit of information about them on investor.gov.
Okay, perfect. So we have another question from Adventure Roma. So what's the best way to report scammers on the phone?
Scammers who contact you by phone, I would say there are two things that I would do. There's one thing, and this is me personally, this is what I do. Now that we're all, not all of us, but a lot of us working from home, you're really aware of all the telemarketers who call every day. Every single unsolicited telemarketer call that I get, I tell them that I'm on the do not call list and that I will report them, and then I hang up and I immediately do report them. So if you're not on the do not call list, go to FTC. That's the Federal Trade Commission, ftc.gov. There's a do not call registry. Put your phone number in there, and then you can also report. And so that's instantly what I do. That's the first thing that I do. The second thing is if the scammer is trying to get you to invest in something as opposed to buy a product or a service, then I would report them to the SEC. And if we have a minute for me to share my screen again, I can show you exactly where you do that.
Okay.
Let me pull up. Oh, I need to move this over here. Sorry. Oops. Just a sec. Okay. So on our website, investor.gov, although it's also Right? If you scroll down, you can see Get Help right here underneath the picture that's on the landing page. On the right-hand side, Get Help, Submit Questions and Complaints. And you click on that and you go to what we call our TCR portal, which stands for Tips, Complaints, and Referrals. And you can submit you can report the fraudulent call right here. And this gets, click on the next part so you can see a little bit. It will go into a form, which I'm not going to go into here, but it's really a pretty simple form. It's very easy to fill out. And that gets looked at each and every day. That's how most of the tips of fraud come into us. You can call us on the number that I put on the screen. You can call us in the Los Angeles office, which is 323-965-3998. You can email us at losangeles@sec.gov. But really, many times the most efficient way is to go onto the website, investor.gov or sec.gov, and look for that link that says submit a complaint or a question. And somebody will look at that really pretty much right away. And that's what my group does is respond to those questions and complaints. We can't always respond with advice because we're not allowed to give business or legal advice, but you can rest assured that even if you don't get a concrete answer in that form, somebody is looking at it and evaluating it. And if it's not within our jurisdiction, we will share it with another law enforcement agency. So, if you think you've been approached by a fraudster, please email us or call us or submit via investor.gov.
Okay, good to know. Thank you. I think I am on that FTC, the call list, but I have to double check because it was such a long time ago. I tried.
Well, and honestly, you're still going to get calls. I'm on it too, and I do still get calls. I get fewer calls, but the more you report it, the more the FTC has the ability to do something about it.
Good. Okay, so elaborating, when you talked about red flags, what are some scams and frauds as of late that are popping up that you're seeing? And
so there are Ponzi schemes are always popular, unfortunately. Market manipulations with penny stocks always very popular, but some things that we're seeing lately, cannabis related stocks. I almost always get a question about cannabis related stocks at the presentations. And this is kind of like I talked about with digital currency. Anything that's new is going to attract innovators, but it's also going to attract fraudsters because they're going to take advantage of the uncertainty and kind of the enthusiasm. So we see quite a few tips about what are really apparent, with some investigation, it becomes clear to us are frauds in both of these areas. People claim to have a bunch of mining machines frequently somewhere else, Malaysia, somewhere where we can't just go and check them out. People claim to be building grow houses out in the desert, and maybe they are, but lots of times they aren't. So these areas, I think, you need to proceed with caution. There are legitimate actors in that area, but there's also a lot of fraud. And then we are seeing more and more of these scams related to some kind of activity on social media, whether it's a Twitter promoting campaign, YouTube promoting campaign. Almost always when I get a tip now, first thing I will do is go to YouTube and look and find. You will find videos of the fraudsters promoting their scheme. So any kind of, I would say, what appears to be, if not orchestrated, at least kind of an upswelling of promotion on a social media platform, I would proceed with a lot of caution there. Because sometimes it is coordinated behind the scenes in ways that aren't really apparent with the goal of manipulating the market.
Good to know. Thank you. Also, what's the most surprising thing you've learned from prosecuting all these investment frauds that you've been doing?
So I prosecuted, just to get some sense of background, I prosecuted some multi-million-dollar Ponzi schemes that almost always also involved criminal prosecutions where the individuals ended up going to prison as well. What was really eye-opening to me when I first started working at the SEC is how persuasive these people were, how easy it was for them to use their charm to persuade, sometimes very well-educated, sophisticated people to participate in the schemes. And then when you peeled that back, when you took away the charm almost always they were the red flags that I described. Um, and I guess, it was really eye-opening how effective those personal skills can be in persuading people to do something they might otherwise be reluctant to do. And that's why this research is so important. Um, that was surprising, and I think also what's surprising to me is how persistent they are. If one scam doesn't work, they're going to try the next scam. Um, and just how pervasive it is. So be careful. Which
Yeah,
is
no,
not to
thank
say,
you.
the U.S. securities market is the strongest and best securities market in the world and has really provided for the financial stability of our country in many, many ways. So that's the plus side. You just have to be able to be aware of the fraudsters as well.
No, thank you for sure. And also for diminished capacity, how do you plan for diminished capacity?
Yeah, that's a really good question because unfortunately, a lot of the schemes do target senior citizens, and they do
Mhm,
because that's where the money is, honestly. If
mhm,
you have been fortunate enough to have a 401k or invest wisely, then you've got these retirement funds in a big pool that somebody in their 20s or 30s is not going to have, at least not yet. And so,
mhm,
unfortunately, we do see a lot of fraud targeted towards seniors. Um, and particularly when there are seniors who become more vulnerable with diminished capacity. So it's important to plan for that before you get to that stage. And one of the
mhm,
best things you can do is identify a trusted person and let your broker know who that trusted person is. And that way, if your broker, if you have a broker and they're monitoring your accounts and they see unusual activity or they see you being encouraged to do something by a third party that you wouldn't ordinarily do, moving
mhm.
money in a way that you wouldn't ordinarily move it, then they can reach out to that trusted person. And that
Okay.
way, it's not happening silently behind the scenes. There's somebody that the broker can reach out to as a trusted person. Um, so if nothing, if you do nothing else, I would really strongly encourage you to identify that trusted person and make them part of your brokerage record.
Perfect. I didn't even know about that, so thank you.
Yeah.
Let's see if we have any more questions. Let's see. Um, I don't know. I think that's about it for questions.
Okay.
Let's. Okay, so I'm gonna thank you so much, Carol. It was very wonderful presentation. I learned a lot. I have to start investing myself. I'm like getting into all the cryptos and everything. So,
It's
um,
I'm not. I can see where it is overwhelming, but one of
yeah.
the things that I wish I myself had learned earlier is how important that early investing is,
Mhm.
because it is very hard to catch up. Time is a really powerful factor in your favor if you use it properly. So
Mhm.
invest carefully, but
Yes.
invest early is probably good advice for a lot of people.
Thank you. Yes, for sure. So I also wanted to let everyone know, thank you everyone for joining us today. Financial Literacy Week is continuing throughout the week through Saturday. Please join us for a week of wonderful financial literacy workshops. Some of the programs we have coming up are your savings, the benefits of opening a bank account, elder care, becoming a smart investor, learning more about financial literacy, and on Saturday, the marquee event, Financial Literacy Day. It's Saturday, April 10th. On that day, you'll be able to make an appointment, one-on-one telephone consultation with a certified financial planner to learn more about all of our events this week. As you see on the screen, go to lapl.org/financial literacy week. So thank you, Carol, once again.
Thank
Wonderful
you.
presentation. Thank you, everyone, for joining us. And have a good rest of your day, everyone. Thank you.